Good morning, everybody. Welcome to See the Futures. My name is Jim Cagnano with NinjaTrader. It's June 21st, 2023. And not only do we have a lot of stuff to talk about, the timing is perfect with Chair Powell being on the hot seat right now at the House Finance Committee. But before we go too far, I do want to remind everybody trading futures, options on futures involves substantial risk of loss, not suitable for all traders and investors. Oftentimes in futures trading, you have a high combination of leverage and volatility. Although that can be an equation for opportunity, it's also an equation for risk. So please fund your futures account with risk capital only. My personal definition of risk capital: money I can afford to lose, doesn't change my lifestyle, lengthen my retirement horizon, or overly stress me out. As a human being, I make bad decisions, and we all do when we're under stress. So be in a good spot. Remember, micro contracts can be friends, and none of this should be construed as trader investment advice, and past performance not indicative of future results. Thanks, everybody, for being here today. Joining me live today from the CME Group, Blue Putnam, Chief Economist, Managing Director of the CME Group. Blue, good morning.
Good morning.
How are you?
I'm doing well.
That's good. I'm so glad we have you on today, because not only did we have CPI last week, PPI last week, FOMC last week, now we have Chair Powell on the hot seat on Capitol Hill. A lot of interesting things going on.
Yeah, Powell's, trying to explain, I guess, what he said in the press conference last week. So we'll see what he says.
Yeah, and it makes for good TV, right? Because when you're at the House level, you're going to have a different group of questions that you're going to get in the Senate level, and it makes for great television.
Oh, yes. And, a couple of the panelists or the senators and representatives have particular hot buttons they like to push. So it does give you a very different view than the press conference does, where I would argue it's a little friendlier most of the time.
Yeah. More questions, more on point, maybe. I'll be nice. But in any event, so we paused, right? We paused or skipped, or I don't know what the right word is, but unched. Unched would be the trader word on Fed funds.
Yeah, I think we paused. We'll see what happens in July, but I'm not sure the Fed knows how to skip. We'll see. I think they're a pause person.
Okay. Well, I mean, after kind of dissecting the press conference, it seemed to me that Chair Powell was quick to point out, hey, data dependent, anything could happen. Yeah, the dot plots are over here, but that could change next time.
Yeah, he was very data dependent. And that's an interesting challenge, because data dependent means you're only looking backwards, yet you're driving forward. I don't recommend doing that in your car. So it's got its issues. But if you look at the data that could happen between now and the next meeting at the end of July, you're not going to learn very much. The headline inflation might tick down another tenth or so, and core inflation might tick down a tenth or so, but you're not really looking at much that could happen that would change thinking.
Yeah. So on that note, yesterday you let me know that the average we're averaging at 2.3% between 2019. And Mike, how do we get to 2% was the question you're talking about.
Yeah, I mean, there's a couple of issues here. We went through 28 years of really low, subdued inflation. There was some noise in it, but it was 2%, give or take. Core was a little less, headline was a little more. And then we had this inflation surge. So the period of subdued inflation was so long, it didn't really have much to do with interest rates. Interest rates went up and down. The stock market went up and down. Unemployment went up and down. But we were kind of stuck there. And we had globalization, which was making supply chains cheaper and goods prices cheaper. We had technology that was really, the internet was allowing people to comparison shop. So consumers became way more empowered, and businesses lost some pricing power, and that was good to keep inflation down. And then demographics, the 90s and early 2000s were very favorable to adding people to the workforce. Baby boomers were hitting peak productivity years, things like that. So that helped keep inflation low. All of those things are in reverse, or at least have changed. The we're going to get artificial intelligence, which I would argue technology is going to be labor saving and it's going to help profit margins. And that's what the stock market's telling us. Supply chains are being re-optimized for resiliency. That's not free. It's going to cost a little more. So that's not helping. And, the baby boomers are retiring. And 20 years ago, we didn't make as many kids. So the labor force is going to be pretty tight. And that's a demographic thing that will, be a headwind. So everything that contributed to that long period of subdued inflation's gone. And now, so what that just means, so it doesn't mean inflation's not coming down. It just means when it comes down, probably come down to 3.5% instead of 2%. And that's going to be a challenge for the Fed. They'll have to think through that one very hard.
Well, the other thing I'm grappling with now that you said that is this idea of average, Paul said this before, averaging, getting a 2% average, which means when you're above 2%, there's got to be a period of time where we're below 2% to get that average, right? Depending on what time frame you're comparing.
Well, the core inflation rate, switching to core, the core rate between 1993 and 2020 was between 0.9 and about 3. So it was really between 1 and 3. So it was volatile. The headline is always more volatile. But you got to remember that when the headline is moving higher than core, it's literally pulling up the core because those higher food and energy prices spread into the core over time. And now the headline is below the core. And so that's going to pull the core down. It just takes a little time. So it's very interesting dynamics going on, that's for sure.
Yeah, and the core, just to refresh my memory, is somewhere above 4% now. So it's kind of, I don't know, I'll use the word sticky, which will get everybody mad, but that's about what we're at.
Yeah, the core, depending on which measure you look, but it's that 4.6, 4.7 on core PCE, and it's below the Fed funds rate. Okay, so that's one measure of is policy restrictive. Are short-term rates higher than the core rate? The answer is yes, policy is restrictive. Another measure, of course, is the inverted yield curve, and short-term rates are higher than long-term yield, so that's restrictive. So we know we're in restrictive territory now. And we know inflation has come down an impressive amount on the headline. We are all kind of focused on that shelter component because it's what makes, I use your word sticky too. That's what makes the core sticky. It's not all the services. It's mainly the shelter, which is still running at 8% and that keeps that thing higher. But you take that out and you realize everything else is doing pretty good. We've had impressive progress. Couldn't say that for a second. We've had it's really been amazing how fast it came down.
So let's focus on the shelter for a second, right? There's two different reports that generate that shelter number, and it's a high percentage of the index, right?
Yes, in the core it's about 40%, in the headline it's about 30%, maybe a little bit more than 30, 32 or so. And there are two parts to it. The biggest part by far is if you own your home, there's a calculation, and it's not an easy one, that says you rent it to yourself every month, and you change the price every month. And then there's another component that's much, much smaller, about 7.5% of the headline, which says that, what are apartment rents and real rental housing actually doing? And that's going up. There's no question that it's more expensive to rent. The annual rate on that over the last 3 months has been about 6%, but it's still too high, or it's still contributing to higher inflation. I don't want to make a value judgment.
So is the reason they do that calculation that way because the idea that your home is an investment instead of anything else, so it shouldn't be in that category of consumption?
Yeah, I mean, a house is an asset. And you're not supposed to put asset prices in consumer prices, but you live in that asset, So it's got a cost. And if you didn't own your home, you'd be renting, or. So there's a very good rationale for what they do, but it is very complex and it's a little bit lagged and it gets a huge weight. And by the way, slightly shifting, but the housing market, given the Fed's rate increases, is a very strange market right now. And so I don't know that you want to base policy on, so much on just housing, because, the housing market, if you bought a house or refinanced your loan in the last 12 years, you're probably sitting at a 30-year mortgage rate of around 3%. So if you sold your house, you'd end up with a new rate at 6.5%. So guess what you do? You don't sell unless you really need to move for some other reason. So the supply of used housing, so to speak, is very, very tight because people are sitting on these super attractive mortgages. And that means that the housing market is right now being driven a little more by new building. So this is great for the home builders. They've lucked into a very following wind when you didn't think they were going to get one. So, housing is a convoluted market. And then you go into major cities and office towers are only at 50% occupancy due to the work from home, but you can't convert an office tower to an apartment very quickly. It may take 3 to 5 years to do a conversion. So that's not going to ease the pressure on apartments right away. So it's just a very unusual housing market, and none of that has to do with much the Fed can control.
Yeah, and construction starts, like you said, yesterday or the day before, I can't remember, were hot. I mean, pretty powerful. And just from a boots on the ground point of view, I'm down in the Charleston area, Blue, and there's residential construction everywhere.
Yeah, because if you want to go out and buy a home and you're looking at, a resale of something, there's just not a big supply. So you got to wait on that new home to be built. There's construction everywhere.
Yeah. Yeah. So if we take CPI and we filter out shelter, what are we looking at?
Well, the headline CPI year over year without shelter would be about 2.3%. And by the way, back in the middle of 2022, when the headline peaked at 9, headline without shelter peaked at 10.6. So it was actually higher and it's come down faster, which is just telling you that everything but shelter is actually doing pretty good. So, how much interest rate pain do you want to give the economy when the only real problem is shelter? That's the question the Fed has to answer. And we don't know, how they're going to come down on that, but it's going to be a very interesting debate. And it's not something they're really focused on yet. They're just talking about the core, but we need to talk a little bit about the parts just because shelter is so unusual.
Yeah, that month over month number in May was, 0.084%. And it's averaging around 0.17% month over month for the last 12 prints. That's pretty small.
It's very small. And the shelter number was, by the way, 0.5 month over month. So you've got, I don't like taking apart the index. So I'm not feeling very good about all this conversation I'm having but when one sector is that important, maybe you do have to take it out. And when it's behaving not in a traditional way. I mean, back in the 50s and 60s, if you raised interest rates, the housing market cratered right away. All you had were 30-year mortgages. You didn't have floating. Most of your loans came from savings and loans, which are gone now, but they borrowed short and lent long. Their business model was to take interest rate risk. So when they got hit by it, they just shut down for a while. And, fast forward to now. Oh, and by the way, back in the 50s and 60s, you did not have interest rate futures. So you couldn't hedge this stuff easily. So now we're in, a modern era. You can do a floating rate, a 10-year, a 15-year, a 30-year. You can do all kinds of different mortgages. You have a mortgage originator who then packages it up and sells it to people who actually want to hold it. So it's not that interest rate risk is built in as a business model. It's a choice you make now. And of course, interest rate futures are the largest futures product on earth. So, financial institutions, most of them are pretty good at managing their interest rate risk. And if they decide to take a position, that's a choice. It's not a business model anymore. So we're in a very different place. All of the things I've said, by the way, make the economy less interest rate sensitive than it used to be. So if you're using a model that has its origins in the 50s, 60s, and 70s, you're going to get everything wrong because the economy is not as sensitive to rates. We can manage our interest rate risk now.
So in the pre-modern era, when I got my first mortgage, we thought 6.5% was great. We loved it.
Yes.
So the paradigm, just the perception has changed alone on what's a good rate and what's not a good rate.
Well, yeah, because you're talking the mortgage rates that were in the mid 80s, and then you go back and I think of my father. Now he got his first mortgages in the 50s and 60s. They were at 3%, where they were for a while recently. But that's not going to happen again for a long time.
So just to go off script a tiny bit, the debt ceiling thing has come and gone. Last time I checked, we were a little over 32 trillion on the national debt. Now, does that number take into account the Fed? Does the Fed take that into account as part of their monetary policy? Policy suggests that they don't.
Well, they're aware of it. So, they follow a lot of things. When the word take into account kind of means, is it a big item? And no, it's not. What the Fed does care a lot about are Treasury balances held at the Fed. The Fed's the banker for the Treasury. And that can affect the overnight funding markets and things like that. So the day-to-day operations. But again, that's not a policy variable. That's just smoothing out day-to-day things. But I will tell you that while the debt crisis may be over, and they suspended the debt ceiling till January of 2025, the government budget debate is not over. And that will heat up from September 30th to the end of the year big time. You're going to get everybody that was in the debate on the debt ceiling has a chance to come back and re-argue it in the fourth quarter, because there's a bunch of appropriations bills that have to pass by September 30th. And if they don't, we end up with continuing resolutions, or we shut the government down, more likely continuing resolutions. But that means that you haven't done anything. Man, we're going to have a huge replay of the debt ceiling debate in the fourth quarter. So it's not gone. It's just not about the debt ceiling anymore. Now it's only about government spending.
Yeah, it'll always only be. We're going to see this story all the time. I remember my first job out of college was with the U.S. Environmental Protection Agency. I was a Fed, and we loved it when we were furloughed. Like when we knew we were going to get back pay, we were getting an extra vacation, basically, and it was great.
I know. People head for Home Depot and Lowe's and fix up their houses and do everything because they do know they're going to get their back pay. It's always happened. Doesn't have to, but it always has. So a lot of things going on there. I will tell you that the fastest, on a percentage basis, the fastest growing item in government expenditures is interest expense. And that was largely ignored in the debt ceiling debate, but it won't be ignored next time around. And that's because, a lot of that debt was financed when long-term treasuries were at 2% or lower. And every time something gets young enough to mature, it's going to be refinanced at a higher rate. So not only is the debt going up, but the refinancing rates are going up. So interest expense is going to be a huge item that's going to be a challenge for setting the budget.
Well, are we making any dent in quantitative easing? Is that making any difference there?
Well, that depends on how you define dent. Let's just say that we went up the elevator at rapid speed, and we're coming down very, very slowly. But it's as the economy grows, and it is still growing, the percent of the Federal Reserve's balance sheet in terms of percent of GDP does shrink, even if they don't do anything, and they are doing a little bit.
So Well, yeah, it's billions versus trillions, right? So we're a
Yes,
couple of
exactly.
orders of magnitude off the mark on that kind of reduction. But maybe it'll be slow and steady for a long period of time.
Yeah, I think, we'll see how the Fed looks back over the 2008 to 2020 period. But I think a lot of economists that are going to study it, and a zillion economists are going to write PhD dissertations on it. They're going to argue that, well, it really hit asset prices. Quantitative easing and zero rates supported equities and bond market prices. And it didn't really do much at all for the real economy. And if that turns out to be the consensus after we've studied it a while, then central banks are probably less likely to do quantitative easing when the economy is growing. I think they'll still go back to it when you have a financial recession like 2008, because for that first round of quantitative easing, the Fed didn't buy treasuries and mortgages. It bought all kind of distressed debt, about $1 trillion worth of it real quick. And then from 2010 on, they sold that and substituted mortgages and treasuries. So I think I just don't see us using QE unless we have a serious financial disaster. And I don't think we're going to go back to zero rates because that had cost. Retirees didn't get their cash. A lot of people that depend on income didn't get their cash. Money market funds didn't work very well. I mean, there were parts of the economy that were definitely hurt, even if corporations and others were helped. And so I think zero is going to, the way I put it in my presentation is 2% is the new zero. When we have a recession, maybe we'll go down to 2%, depending on how bad it is, but we probably won't go to zero.
And you're referring to that from a GDP measure point of view.
Yeah, well, a recession to me is, you get unemployment going up 5.5%, 6% and rising. I'm more of a jobs guy than a GDP guy when it comes to thinking about recessions.
Yeah, and it just doesn't seem like we're going to break that five handle anytime soon. It's just been incredible.
Yeah, a lot of Wall Street and technology jobs were created in the middle of the pandemic because they actually benefited and they needed to take advantage of that. And they ended up hiring workers. And now those advantages have disappeared. And, they're needing to trim back. But in most cases, their hiring they still have more workers today than they had in 2019. And we're not adding the growth rate of the 15 to 25-year-old category, zero. We're not adding any young people, and boomers are retiring right and left. So the labor market's going to stay tight.
My kids better hurry up and get a job. They're in that 20 to 25 group right now. So, but do you think, does the working remote help, right? So now we're in a situation where maybe you don't have to have a big office rent expense. Instead, maybe you could add more human resources with this work remote phenomenon.
I don't know how that's going to work. I do think businesses that spent a lot of time analyzing their financial capital will spend more time over the next 4 or 5 years analyzing their human capital. That I think will happen. But I don't know the answers because there's an awful lot of advantages of meeting as a group, particularly for creatives and things, and figure things out together, which is hard to do virtually. But meetings like what we're doing virtually is a piece of cake. So I'm home today. So I don't know how it's going to work out in terms of the mix of work from home and so forth. But, when you bring on new employees to a company, you need that personal contact. So there's a lot of reasons to suggest that we're not at an equilibrium yet. But there are going to be certain types of jobs that can stay work from home and others that you're just going to have to go back to the office, and we'll just see how that mix turns out. The big issue for that, though, is not so much how corporations figure it out, but what happens to the center cities that depend on commuters. New York, San Francisco, Houston, Chicago, these cities, those office towers at 50% occupancy most of the week. And by the way, that 50% is concentrated on Tuesday, Wednesday, and Thursday. So, what do the restaurants do? What do the services do? What's their new business plan? I mean, we're still in transition. Don't make any, we're not there yet. We haven't found the answers.
So there's two different distinct ideologies here. One, this is the new normal, and two, everything's got to go back to the way it is for the very reasons you're saying: collaboration, organization, and all of that stuff. I don't know what it's going to be either, but technology sure is helping us do it this way.
Technology, we couldn't have done it this way 30 years ago. So technology has given us options, and options are always good, by the way. Having options, you shouldn't trade those. You shouldn't sell those options to maturity. You can trade them, but options are excellent value here. I mean, we have more options. There's no doubt about it on how we come out on the work from home situation. It's going to evolve, though. One thing, though, the toothpaste is out of the tube. It does not go back in, but we don't go back to the way it was. We figure something new out. And I don't like calling it a new normal, but it'll be a new reality, and then it'll change too when the next round of technology and events change it. But this is a problem I have with economic models. A lot of economic models can be run forward and backwards. Okay, they're mathematical equations. They can kind of work either way. If you build a model like that and use it, I think you're in big trouble, because what you learn from the people in physics is that what they call the arrow of time. But what that really means is that when something super big happens, like say I'm at the top of an expert ski slope and I decide to go down, I am not going back up the same way I came down. That's just not possible. Okay. And that's the way economies work. When you have a big shock like a pandemic and you change and now we have the shock of higher interest rates, you are not going back to the way it was. You're going to process everything and develop some new reality. So we're still in a transition phase. So I build models that can't go backwards. They only go forward. And when you have a big shock, there's no running, so it's a very different kind of model building.
So that just brought up, we don't have enough time to cover all my questions, but I got to throw in, I got to ask about, the China situation, your relations with China. To give you my point of view. My point of view is that there's so much trade there, it'll never deteriorate too badly. But the headlines seem to suggest there's the possibility of that.
Well, it certainly started deteriorating back in 2018 when the U.S. started putting tariffs on things and so forth. And it's just gotten only more difficult. And by the way, this is a bipartisan issue in the U.S. In terms of, being wary of China for a whole variety of reasons. But China's a big country, second largest in the world. We're a big country, number one. We're going to trade. But if you are a business, you're not going to put all your eggs in the China basket. And they sure aren't going to put all their eggs in a U.S. basket. So diversification, supply chain resilience, things like that has its cost, because basically from the early 90s to 2018, supply chains were optimized to be the lowest possible cost. There was really no other reason to figure things out. Well, now you got 3 or 4 different things. You got geopolitics. You want to be resilient. You want to be diversified. That's going to cost money. But one sense of globalization has ended, but we're going to stay global because it's just a way more efficient model. But I'm going to have a factory in a couple of different places.
Got it. Totally makes sense. One last question. I'm going to change gears 1 second. We're almost out of time. Senate Banking Committee hearing today. Nomination on Adrian Kugler to the board. Also, Philip Jefferson might get a promotion to vice chair, and then second term for Lisa Cook. Does any of that, will that matter going forward to the next FOMC?
It does not matter for the next FOMC, but it does matter for the culture of the Fed over the next 4 or 5 years. these appointments provide more diversification of points of view, of experiences, of history, of education than we've seen in a while. I'm a Bayesian statistician. I love drawing from many different sources. So I think that the Fed culture will actually work out very well with these appointments. But as far as the next couple of FOMC meetings, I don't see any impact.
Got it. All right. Makes total sense. Well, Blue, we are out of time. Thank you so much for being here. Greatly appreciate your wisdom, knowledge, information, and spending time with us today.
I've enjoyed it, and we had a couple of segues that were fun. So we'll see where we go next time.
All right. That sounds good. I'm looking forward to it. Everybody, thank you for being here. Greatly appreciate everybody being here and listening to me and Blue. And as usual, remember, most important message, please be safe out there. Be good to each other. Thank you.